Hey everyone, happy Thursday, May 14th. It's about 9:15 in the morning on the West Coast, and it's time for another market update. Well, it's a really busy over the last week. There's been a lot of really important data reports that came out, but as we've talked about, the main focus still is the war with Iran and more international matters. It seems like the peace deal is kind of on life support, where we might start hostilities again, which would not be good, obviously, for what we want. We want all that to get resolved so oil, runs freely in that area and inflation comes down and whatnot. But so it seems like that, the war could be back on. I know that President Trump is in China meeting with President Xi of China. That seems to be the hope where that will get resolved. So that's going on. And then the other thing that came out, I combined these two just to get it all in one line, basically. But the Fed has confirmed Kevin Warsh as its new chair. The markets are liking that. He should be friendly towards bonds. He should be looking for reasons to cut rates compared to Chairman Powell. So the markets are reacting positively to that today. So those are kind of offsetting each other. Still a lot of focus on Iran and the war with them and what's going to happen there as far as the peace deal goes. But the markets did like the fact that we are getting a new Fed chair that should be more friendly to the markets, relatively speaking, at least compared to how people felt Powell was doing. So that takes care of the more the narrative stuff. And again, it's kind of the main focus right now. I know the markets are kind of moving up and down today, especially with some of the China stuff coming out. But getting to the data, going back to last Friday, we got the April BLS jobs report. Like we've talked about in the past, this is the big jobs report. This is the one that drives the markets in normal times when the markets are not obsessed with the war going on. But this is an important one, and it's been something that has not been very friendly to us over the last couple of years, and it continued not to be very friendly to us. But luckily, the markets were distracted by the war, so it came in at 115,000 jobs created, and that was above expectations. The unemployment rate stayed at 4.3%, which was expected. As you can see there, February and March were revised lower by 16,000. That's been a common theme. We've talked about that. They come out with these numbers, then they look at them and say, hey, we were wrong. Those were too high. But at that point, the markets have already reacted. So that has not been pleasant to deal with. And then later on in the year, they actually really count the numbers and they get even lower. So we've talked about that ad nauseum. So basically, this report was not what we necessarily want to see. But again, with the markets distracted by Iran, it didn't really have a huge effect. Like I said, unemployment stayed where it's at, and there was more jobs created than expected. But we probably should expect that to come down in the future. Next thing we got. So inflation this week. I'm sure if you've been paying attention to financial news, you've seen a lot about inflation and it jumping higher. So what we got was we got both the CPI right here for the month of April, and that jumped 0.6% in the headline and 0.4% in the core, which were both higher than expectations. As you can see, the headline there, the pretty big jump since February. And again, these are consumer prices. So this is what we're paying. It's not the Fed's favorite report, which is the PCE report, but this one comes out first. So, if anything, this is kind of taking on more importance lately because it's giving us an early look at what we might see in that PCE report later in the month. But a lot of this obviously has to do with rising food, gas, and energy prices. Obviously, a lot of that has to do with what's going on with the war with Iran and the Strait being closed and whatnot. So that's this was expected, but not this much. So this, kind of spooked the markets a little bit. Like we've talked about, we want jobs like the previous one to look weaker, which it was not, and we want inflation to come down in order to get the Fed to cut rates. So this was higher than expected. And then the next one we got yesterday, which really riled the markets, was the producer prices, so the PPI. So this is where basically, we're the consumers. This is the producers, the people that produce the goods that we end up consuming. And this was up 6% year over year, which I think is the highest in about 3 years. In graph form, you can see it was really high going back into the pandemic, and then it came down. And then we've kind of been on an upward trajectory, especially since this war started. And again, these numbers were expected to go up, but they went up way more than expected. And the worry there is if the cost goes up for the producer, the people that are producing these goods, generally they pass it on to us as the consumer. So our prices go up. So all that stuff causes inflation, obviously, and we don't want inflation, and so that is a bad thing for what we want. Eventually, is for the Fed to cut rates. The worry there is if they cut rates, inflation stays where it's at or it gets even worse. And then we're back where we started to. So that will be the job of Kevin Warsh coming up, is to try to navigate that dynamic of wanting to cut rates, but at the same time, if you cut rates, you could cause more inflation. But these reports, both the CPI and the PPI, going up more than expected, were not something we wanted to see, but also something kind of expected with what's going on in Iran. So where does that leave us? So the average 30-year conventional for good borrowers, putting at least 30% down, kind of thing. According to this lender survey, it's Mortgage News Daily. It came in at about 6.55 today. Last week we were at 6.44, which I think is again the highest in about the last 6 weeks. Since the middle of March, I believe, this is the high point. So again, not what we want to see. We had dip below 6. Now we are above 6.5. Going the opposite direction where we all wanted it to go. So this obviously is very, very directly correlated to this war going on. If that gets cleared up, obviously that would help. But as we've seen, what's the next thing that's going to pop up at that point? So, not a good thing to see. You will have to, again, the new Fed president, Kevin Warsh, taking over, or Fed chair taking over, that will be a good thing. He, like I said, he probably should be looking for reasons to cut compared to, maybe being a little more spooked by the data. So positive thinking there, but again, not good to see rates keep going up again. So important dates. So we have on May 28th, we get that PCE report I mentioned. On June 5th, we get the next BLS jobs report. On June 10th, we're going to get a CPI report. And on June 17th, that will be the Fed's next meeting. That will be the first meeting chaired by Kevin Warsh. So we'll have to see that goes. The markets, again, right now are not expecting to cut it at that point. They're expecting to keep it where it's at. So we'll have to see how things go up until then. But like we talked about, a lot of this stuff is directly correlated to that war going on with Iran. So once that gets cleared up and peace happens, and trade starts going freely through the strait and things like that, that's when we can kind of get an idea of maybe when rates would come down. As long as that's going on, there's going to be a lot of uncertainty and a lot of volatility in the market. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.